Welcome back. We are watching a market rally underway this Monday morning. I hope you're having a good Monday morning. Take a look at where stocks are. Dow Industrials up 236. We are kicking off the final full trading week of 2025 with a pretty good move. The NASDAQ right now up 120 points. This after all three major indices ended lower on Friday as investors pulled out of the AI trade on Friday, with the NASDAQ down 398 at 4 o'clock on Wall Street. A big year for the economy, the Fed delivering 3 straight rate cuts. We've got record highs in gold prices, but there, of course, were several economic hiccups as well, including the longest government shutdown in history. Through it all, one theme stood out. Big tech and AI drove markets to new record highs, despite growing concerns about valuations. Now we are down to the final 2 major big decisions for markets for the year. And that is, number one, what will the Supreme Court say about the president's use of tariffs in an emergency? And number two, who will be our next chairman of the Federal Reserve? We are waiting on an announcement from the president. Joining me now is Mendon Capital Advisors President and Chief Investment Officer, Anton Schutz. Anton, it's so good to see you this morning. How are you doing, sir?
I'm doing great, thanks. Pleasure to be with you.
We want to talk a little about what is going to drive this market. And we know that President Trump told the Wall Street Journal he's down to 2 players as chairman of the Federal Reserve, Kevin Hassett and Kevin Warsh. I want to play a little sound from both of them as they joined me multiple times in the last couple of months. Here is Kevin Hassett, the current sitting head of the National Economic Council, followed by Kevin Warsh, a former governor of the Fed. Watch it.
Because of the really big increase in productivity, I think we could be looking at a 4% productivity increase next year, given how much acceleration there is in AI. Then what happens is that workers are able to produce as much stuff as the firm needs without having to hire a whole bunch of new people. And so we're seeing that recent college graduates are feeling stress right now. But our expectation is that this is something that's going to work out quickly. The AI economy is moving much faster than the dot-com economy of the 90s. And the coaches that AI is producing are going to help make a lot of productive workers a heck of a lot of money. And the bottom line is that we're seeing that real wage growth is really high again this year after, being down $3,000 during the Biden administration. And so all this productivity is putting more money in people's pockets.
The Fed has lost its way. It's lost its way in supervision. It's lost its way in monetary policy. And all this big money on big fancy buildings is just another indication. Why does that matter, Maria? It matters because what matters most to the Fed is credibility. The Fed has to look like a serious, sober institution. And if you look back to where we were last September, the Fed cut rates 50 basis points before the election.
Right before the election.
Another 50 basis points after. Hadn't done that kind of thing around an election in 50 years. But what happened? Markets are smart. The Fed cut rates. Long-term interest rates went up almost a percentage point. That's because they're losing credibility. Whatever happens next, whatever decisions the president makes, the next head of the Fed and the Federal Reserve needs to rebuild that credibility. So when you cut rates, you know what happens? Rates fall across the yield curve so that small businesses and homeowners can start to afford things that are right now only affordable on Wall Street.
Anton Schutz, what's your take? Will the market react differently depending on who President Trump chooses for the chairman of the Fed, Kevin Warsh or Kevin Hassett?
Well, they're going to choose Kevin. So that's clear. They're both named Kevin. Now, here's the issue. Wall Street's perception of Hassett is that he's going to lean much more to whatever Trump says, and Warsh won't. I mean, I disagree with that. I think both of them have the same agenda, as in they want to lower short-term rates. They want to create affordability. I don't think either one espouses the end of Fed independence. I think it's a perception that Hassett may be more leaning towards doing whatever Trump says. I disagree with that. I think he will do what's right. And I think when you take that job, you do what's right. And I think that if you look at the political agenda of any president, they've always had a chance to appoint heads of the Fed, and they're going to appoint who agrees with their economic policy. Clearly, both of these potential candidates are doves. They're going to lower rates. And I think we really have a problem with 2 economies, right? We have a stock market that's doing terrifically, and we have a housing market that's unaffordable, and it's very difficult for people to afford houses. So how do we get mortgage rates down? I think that's going to be a task of the Fed, whether they do an Operation Twist, whether the Treasury changes the way it issues debt. We've got to get long rates down as well as short rates. We've got to create affordability for the housing. I think that's a real issue for both of them to tackle. And I think the real risk for any Fed chairman today and the Fed itself is this dual mandate, right? We have unemployment, you're trying to keep that down, and you're trying to keep inflation down. Well, how do you do that when you have an AI economy that's probably going to create some job losses? Efficiency is great. We're certainly going to have strong GDP, but rates are going to have to be lower to create affordability for many Americans, and I think that's the challenge for the Fed. And obviously, you don't keep them too low for too long. We clearly saw that with Powell when he kept rates for too long. He got reappointed, kept rates too low. That helped cause inflation. It wasn't the only cause, but it clearly was a cause. So the Fed and its role here is really important, and clearly it was very political, I believe, when rates were too low for too long.
Yeah, well, that's what Kevin Warsh said as well. So, Anton, you expect the market rally to broaden out in 2026, potentially away from the Mag 7 towards cyclicals and smaller caps. How do you want to be allocating capital here if you are also of the belief, which I think you are, that we'll see consolidation in the mid-size and smaller banks as well?
Yeah, I mean, there's no doubt about it. I mean, banks are a pretty large percentage of the Russell 2000 as well, so that will certainly help their valuation go up. They're still at historic lows versus any other indexes, versus on a PE ratio, especially as you get down smaller. Now, let's count the ways that the wind is in the sails, right? We've got a yield curve. Rates are probably going to drop some more. Funding will get better. That helps credit as well when rates come down. So that's terrific. You've got less regulation. The Fed and all the other regulatory bodies were incredibly onerous on the banking industry, from the smallest to the biggest. That's easing. Clearly, encouraging mergers to happen is something that regulators want. We've seen some companies do multiple deals already within the year. We're going to see much more of that. And I think it's really important. And by the way, those institutions need to invest in technology, and they need to be able to utilize AI and other tools. And the best way to do it is to continue to get bigger. You've got the barbell out there of JP Morgan investing $17 billion a year in technology. I mean, it's pretty incredible. But if you're small, you've got to have that access.
Absolutely. Anton, it's great to see you. We so appreciate your time, and we wish you a very strong 2026. Thank you, sir.
Thank you. Look forward to it.
All right.
Be well.
We will see you soon. Anton Schutz joining us. Stay with us. We'll be right back.